Okay. Three, two, one. Hello and welcome to another round of My CPE Insights. My name is Jason Dynison, taking you through some of the top accounting and tax stories from the past few weeks. Three, two, one. So we all know, I think, about the one big beautiful bill that was signed into law on the 4th of July, which extends a lot of Tax Cuts and Jobs Act things, or actually makes TCJA things permanent in many cases, and then adds some twists and new things to the law as well. One of the big things with it is the SALT deduction. So TCJA put into place the SALT limit of $10,000. So that's the most that people can deduct for their state taxes, income tax, property tax. The big beautiful bill ups that to 40,000, temporarily at least through 2029. And so that will help people in places that would be considered higher tax states. And it also impacts planning with what are called PTETs. And that gets a little complicated. What are PTETs? It's for certain entities, S corps and partnerships. They could pay the tax on behalf of the partner or shareholder. And then they take a deduction on the entity return, which reduces income on the K1 to the partner or shareholder. So it's a workaround to the SALT limit. There's some planning in place now because of the increased SALT limit up to $40,000 now. There'll be more planning involved on whether or not a PTET is useful or not. So that's one thing at the state level. I mean, it's a federal issue, but it's something that states have done to work around the older $10,000 SALT limit. What about the impact on state revenue, though, from the big beautiful bill? Well, some of it depends on where you live. So there was some research from the Tax Foundation that says the average savings per filer is projected to be about $3,700 under the big beautiful bill. But it varies depending on where you are. So in Wyoming, it's 53, almost 5,400, whereas in West Virginia, it's only 2,500. And then it depends too on, even if you drill down to the local level, Teton County, Wyoming, which would be near Yellowstone, 37,000, whereas in some rural areas it might only be 800. And that's in large part that's because, the lower your income is, the lower your tax is, so the lower your savings is. And so with the SALT limit going up, people in higher tax areas will get a much bigger deduction, and more people are going to itemize. One of the things that happened in my practice was probably 85 to 90% of people who used to itemize pre-TCJA didn't itemize. After TCJA, because of a combination of increased standard deductions and the SALT limit. Well, now the SALT limit is $40,000, so more people are going to be itemizing. So the overall effect is higher tax states, higher states with higher income and property taxes, people living in those states could see a bigger benefit because of the increased salt limit. And rural states will likely see lower benefits under the big, beautiful bill. Now, the IRS recently came out with some pushback on a rumor about stimulus checks being sent to people. Kind of a weird dollar amount, too, $1,390. Stimulus checks being sent out. That is not true. Although this didn't come out of thin air, there have been some real stimulus payments sent, but that was way back during COVID, during the pandemic. The last round of stimulus checks was sent out in 2021, and that one was $1,400 per person. The IRS, now I don't think it's in this article, but the IRS has come out with some other things in the last few days also, talking about how social media is pushing a lot of incorrect information. So it's just more things that we as professionals need to be aware of. There has been some talk. Senator Josh Hawley has talked about something called the American Worker Rebate Act, but that's just a proposal. Nothing has happened with that. The bill has not advanced. President Trump has talked about some kind of refund payment or whatever for tariffs, but again, nothing has actually happened. The cost of tax complexity. The estimate on that is $536 billion for compliance. It's estimated that Americans will spend over 7 billion hours complying with tax law. People have said, I've heard this in several places through the years, that U.S. tax law is the most complicated law in America. It may well be the most complicated law in the world. Although, I mean, other countries have pretty complicated tax systems too, but certainly in the United States, tax law is probably the most complex law in the land. And so the cost of compliance is quite high. And in addition to the big, beautiful bill, we have other things that are taking effect this year. Form 1099-DA for digital assets. Certain brokers who deal with things like Bitcoin and other digital assets, they'll need to be reporting those transactions, bringing some of that out in the open. One of the problems, though, with all this tax compliance is that the IRS's technology remains stuck in the past. And so there's more complexity. There are more reporting forms and more information that will be pouring into the IRS, but how will they deal with all of that information? New York City is proposing, well, not New York City itself, but mayoral candidate Zoran Mamdani has proposed a 2% tax on people earning over $1 million a year, which could generate an additional $10 billion in revenue. The thing that's always hard when talking about these sorts of things, whether it's this or it's legislation in Congress, is until there's a real bill put forward and it's debated and voted on, it's just talk. Just like we talked about with the stimulus checks and some of the talk about stimulus checks really being sent at some point. Well, that hasn't happened. There'd have to be a bill put forward to make it happen. But there's this mayoral candidate has proposed this 2% tax on people making over $1 million annually for New York City. And the funds would be used for various social programs, busing, childcare, rent freezes. And as the article says, there's risk with high earners looking to relocate because of this, which then would um, limit the usefulness of this tax. And if we look at this chart here, though, we could see the people earning a million or more has increased some through the years. This chart stops at 2022, but it's gone up a little bit from 2015. But what would happen if this tax took effect? People would either move or they would find their ways to probably get around this. There have been states that have proposed or even implemented. Massachusetts has implemented a millionaire tax. Illinois and California are exploring it. But as always, this is not law or whatever it would be called in New York City. I guess it would be a law, a local tax. It hasn't happened. One of the candidates who's running for mayor is proposing it. Some other accounting news. Keurig Dr. Pepper has acquired the Dutch coffee company JDE Peet's for, in US dollars, around $18 billion. Now, rather than folding this acquisition into the Dr. Pepper empire, this company will be split off, and there'll be two separate US listed companies. And so these companies are merging. If Keurig, the coffee company, Keurig Green Mountain, merged with Dr. Pepper Snapple, creating the seventh largest food and beverage company in the United States, with around 11 billion in revenue at the time back in 2018 when they merged. Coffee sales have dropped slightly, 0.2%. The cost of coffee has been going up, up, up. Not just at stores like going to Starbucks and getting your latte, but like if you're buying your own coffee off the shelf at the grocery store, that's gone way up also. People are not drinking as much coffee from coffee shops, so Starbucks has announced it's cutting production at its US roasting plants because demand has gone down as the price of coffee has gone up. Well, every now and then we point out some of the things that are happening with some of the bigger accounting firms and what's been going on with audit failures and sanctions from regulating bodies. In Hong Kong, accounting regulators have hit Deloitte with about $245,000 in penalties because of deficiencies in audits. This goes all the way back to 2011. Now, I suppose in the grand scheme of things, 245,000 for these gigantic firms might be not that huge, but I mean, that's got to hurt a little bit to have to pay that much money out in penalties. So this goes back to 2011 to 2013 with these two companies that appeared solid at the time, but it ended up that they overstated revenue. And as regulators started taking a look, there were some things that had gone wrong. And The regulators felt like the auditors didn't apply enough professional skepticism to everything. So the end result, 245,000 US dollars in fines. This is just a little story here about a little accounting trick that's being done by teams in the Premier League, which is one of the big soccer leagues out there. Some creative accounting that involves a lot of these teams have a men's team and a women's team. And so, for example, Chelsea pulled off a stunt where the club sold its women's team to its own parent company for $269 million. The real value is closer to, in pounds, 60 million. So, three and a half times more. But what ended up happening is that the parent company this was booked as revenue, selling to itself, caused it to book revenue and kept itself in line with different rules about what are called profit and sustainability rules for teams. And now other teams have done this, selling their women's team to their own owners so that the club can book revenue, which makes it, of course, seem like it's doing a lot better on paper. This is because rules only allow teams to show 105 million pounds in losses over 3 years. And so if you're pushing up against that, you either have to make cuts in spending so that you fall below that, or increase revenue some way. So this is a way, at least temporarily, it helps boost revenue and keeps teams within this league rule about limiting losses. That is one of the problems, though, is that this is just a paper profit. It's not a real world profit. And I don't know, at some point, it seems like the gig would be up on this. What are they going to do as the next few years go along and this sale revenue starts being pushed into the background? And then we'll close with just more from the tax fraud blotter. This is a little different. A lot of these schemes involve Form 1040. This involved Form 1041. So this guy in Los Angeles is accused of engaging in this scam where he claimed hundreds of millions of dollars in refunds using Form 1041 for trusts and estates. He also did some things on Form 1040 as well. The IRS ended up actually paying him $6.2 million in refunds before he got busted. So this guy, he got this money to the tune of $6.2 million. He bought a house in Malibu, 2 Teslas, and $500,000 in crypto. And depending on when all of this was paid out and when it happened, I mean, you buy crypto back in, say, well, pre-COVID for $500,000. If it was Bitcoin, that would be worth a lot of money nowadays. He also recruited at least 17 others in this scheme and charged fees for teaching them the techniques of fake refund filings. That funneled $870,000 into his pocket. Now, the IRS eventually caught on to this. Sometimes the IRS is slow. but they do catch on to these things. And IRS criminal investigation specialists started investigating. By the way, when criminal investigation starts investigating, the percentage is quite high. It's somewhere around 90% or so, where you're going to go down when they start investigating you. Criminal investigation is quite good at what they do. And I always wonder with these people doing this, it's like, how do they think it's going to end? It's like, okay, you got all this today, but you're not thinking about what might happen tomorrow. And so this guy got busted and has some problems now with the government. So that is our recap of some of the top stories in accounting and tax over the last few weeks. I'm Jason Dynison. Thanks for joining us, and we'll talk to you again next time.